So an indexed annuity is what I would call a moderate investment. You're only risking how much you could make. You're not risking how much you could lose. If you'd like to learn more about different investment styles, not just moderate, but also conservative and aggressive, check out the link in the description below. Indexed annuities. What are they? How do they work? How to know if one might be right for you? Well, at this point, you might have already seen my video on annuities, or you might have already seen the video on income riders. Today's video is going to be specifically on indexed annuities. So what is an indexed annuity? Well, an indexed annuity is a type of deferred annuity, which is an investment account that at some point in the future, if you wanted to, it could be turned into a pension. Now, most folks never turn it into a pension. Most folks always leave it in its deferral status, in which it's like any other investment. You make deposits and you make withdrawals. What's unique about an indexed annuity is the way the money's invested. They invest your money in such a way that when the stock market goes up in value, you participate in that. But when the stock market goes down in value, you do not participate in that. So when the market goes up, you receive a percentage growth that is not quite the same as the market. It's a little bit less. But when the market goes down, your account does not lose a penny. Now, if I told you you could get all of the growth with none of the risk, that would be too good to be true. But if I was to say you could get half to 2/3 of the growth with none of the risk, well, then that is an indexed annuity. So how are they able to do this? How are they able to get you half to 2/3 of the growth when things go well and not suffer any losses at all when things go badly? And the answer is based on how they invest the money. They're only gambling with your interest. They're never gambling with your principal. So with an indexed annuity, your premium or your deposit into the indexed annuity goes into something safe and interest-bearing. Think of it like a jumbo CD. Now, typically with CDs, the interest reinvests and the account compounds. But with an indexed annuity, they gamble with your interest. They actually speculate with it. They take a big chance with it. How they take a big chance with it is by buying call options. Now, a call option is when you pay a little bit of money today to lock in a price for now and into the future. So if the stock happens to go up in value, you've locked in being able to buy it at the cheap price, and then you could sell it at the higher price and you would profit. So by buying a call option, you're buying the rights to any future profits. And that's what the indexed annuity provider is doing for you behind the scenes. So they're only gambling with your interest. If it's a year when things go poorly and the stock market goes down, well, that gamble didn't pay off. It was a loser. But they only gambled with your interest. They did not gamble with your principal. And in years when the market goes up, that gamble pays off to give a return in excess of simply staying level. So if the market goes up 10%, maybe your indexed annuity gets 5, 6, 7%. Now, the nice thing about an indexed annuity with an annual reset feature is each year, as gains are credited, they get locked in. So if the next year the market drops, you still have your previous year's growth in the account safely. And also, because of the annual reset feature, as soon as the market starts to recover after a drop, you start to profit again right away. So if the market was here and then dropped and then recovered, the indexed annuity would stay level when the market drops, and then as the market recovers, it starts to grow again right away as well. So it's like a ratchet. It only goes up, it does not go down. Indexed annuities are right for folks who want to play the market but don't want to take any risk of loss. They're right for folks who are age 60 to 75, 80 years of age, where you're too old to be running all the risk of the market, but you're too young to only get 2, 3, maybe 4% in a CD or a fixed annuity. So if you're under the age of 60 and you really like this concept of the indexed annuity, it doesn't mean that it's wrong for you. It could still be right. The indexed annuity is popular for folks 60 to 75 who were aggressive, who are now becoming moderate. But it's also popular with folks of any age who want to get a good rate of return but do it safely. A word of caution though here, indexed annuities are tax deferred, and that's a good thing. The money grows year in and year out without income tax being assessed. However, they have some requirements that you leave the money in there until 59 and a half years of age, similar to an IRA. If withdrawals are made prior to 59 and a half years of age, then there would be a 10% income tax penalty on those withdrawals. So if you're 30 years of age and you like this indexed annuity concept and you're willing to set the money aside and have it grow without risk until you're 60, it would be a perfect option. But if you're 30 years of age and you want to set this money aside for 20 years, let's say, until you're going to use it at age 50, then the indexed annuity would not be a good option. However, there are other types of investments that do the same thing, that get you the growth without the risk, and those would be equity-linked notes and stock market certificates of deposit. All three of these moderate types of accounts are discussed in another video called Investment Styles, and you can follow the link below to that video. So by now you know that an indexed annuity is an investment where you're just gambling with how much interest you could make. You're not gambling with whether or not you'll lose any of your principal. And every year as interest is credited, it gets locked in so it won't go backwards in the future. But there's some other things you want to think about and know about when it comes to an indexed annuity. You want to be familiar with the different index choices, the crediting methods, and whether or not you want to add any riders onto the account. Now the index choices, these are different major indexes that you can base the interest or the growth on your account off of. The most common of which is the S&P 500 index. The S&P 500 index, or Standard & Poor's, is made up of the 500 largest companies making up the American economy. So just with that one index, you're very well diversified across 500 different companies. If the S&P 500 index goes up, your account earns interest, but if the S&P 500 goes down, you don't lose anything. But that's by no means the only index. Standard & Poor's also has a mid-cap index of 400 mid-sized companies. That's a very popular choice inside indexed annuities as well. Russell 2000 is an index of the 4,001st to 6,000th largest publicly traded American companies. It's referred to as a small cap index, but if you're working for the 6,000th largest company in America, it's a pretty big company. So I think of it more as a second mid cap. There's also specialty indexes like the NASDAQ. The ticker symbol for that is QQQ. The NASDAQ is the 100 largest companies that are traded via computer, not face-to-face like you see in movies and television with Wall Street, but one computer matches up buyers and sellers in an organized fashion. The NASDAQ is an index as well. Europe, Asia, and Far East is an index. And the Financial Times Stock Exchange, which is like the Dow Jones Industrial Average of the United Kingdom, that's a popular choice as well. And of course, the Dow Jones, or the Dow also. So these are all different indexes available commonly through indexed annuities. So one of the first steps after you've decided that an indexed annuity is right for you is which indexes are you most interested in tying your interest to. So once you've chosen your indexes that you want to tie your interest to, the next step is deciding which crediting method you want to use. The crediting method is the calculation or the math behind the scenes on calculating how much of the stock market's growth you'll actually receive as the investor. Now keep in mind, no crediting method will get you 100% of the growth. Because if there is an investment out there that got you all of the upside, but none of the downside, that's too good to be true. Remember, an indexed annuity gets you half to 2/3 of the upside in good times while suffering no losses in the bad times. So the crediting methods is the calculation of how much of the upside do you actually get. The simplest of all of the crediting methods is known as annual point-to-point. They simply take a look at where the stock market index was at when your account was opened, and look at 1 year later where the stock market index is at that time. They calculate the percentage difference between those 2 points, and then they assess a percentage. So let's say it's annual point to point with what's known as a 50% participation rate. So if from January 1st of this year till January 1st of next year, the stock market's up 10%, and you're in the annual point to point with a 50% participation rate, they would credit you 5%. Now, if from January 1st to January 1st, the market's down 10%, well, then your account stays level. You don't lose anything. And that's the beauty of an indexed annuity. So the simplest of all the crediting methods is the annual point to point, simply 1 point in time compared to the same point a year later. Now, what's nice about it is it's simple, but what's not nice about it is if there happens to be what we call a fat finger day. A fat finger day is when somebody's fat finger enters a cell by accident, which triggers the next computer to sell, which triggers the next one to sell, and the stock market drops 300, 600, 900 points in a day for really no good reason, and then the next day the market's back up again. Well, if that happened to be your end point on your annual point to point, bad news is you're not making any interest that year. But there's a silver lining, and that is the end point of this year is the beginning point of next year. So next year, you're starting at that lower fat finger mark in the calculations going forward. But it's not a perfect silver lining because remember, you're getting half to 2/3 of the participation of the up. So for folks who are concerned about that, the second crediting method is known as monthly averaging. With monthly averaging, they compare the start to where the account was opened to the next 12 months' values all added together, divided by 12. So they compare the start to the average. So even though the finish point might be a fat finger day for you, it's only 1 out of 12 instances that they're looking at in calculating your interest. So let's say over the year, on average, the stock market was up 6%. Well, then you know that you're on pace to get somewhere close to 6% credited to your indexed annuity. So the averaging takes out the spikes and the valleys. The averaging crediting method is a way in which you can actually have interest credited and locked into your account in a year when the market actually finishes down. So if the market was up most of the year, but then finishes lower, on average, it still could have been higher than the beginning of the year. So with the averaging method, you're actually going to have interest credited in a year when the market finishes lower. The averaging method is great for consistency. So if you always want to be earning something on your indexed annuity, using the averaging crediting method is good. But there's a downside to the crediting of averaging, and that's if it's a year when the market goes straight up. If the market goes straight up, let's say it starts here and it finishes 20% higher, well, on average, the market was only 10% higher for that year. So the averaging in a real strong market will not get you as much of the upside as you might have hoped for. That's why they've come up with the third most popular crediting method, known as monthly sum. The monthly sum is the best crediting method in a strong bull market. The way the monthly sum works is any month the market goes up, they credit you interest up to a cap. Let's say 2% as an example here. So if 1 month the market goes up 1%, they credit 1% to your column. If the next month the market goes up 2%, they credit 2% to your column. If the next month the market goes up 3%, they would credit 2% to your column. So that's the cap, 2% per month. If you hit it all just right, you could actually have 24% in just 1 year in an investment that's literally insured against loss. I know it sounds too good to be true, but it's not. We've actually had this happen with clients back in 2003 to 2004, and then again in 2009 to 2010, where folks capped out and got the maximum amount of interest. But the monthly sum is not a perfect crediting method because they also write down the negatives as well. So if 1 month the market goes down 1%, they'll put a -1% in your column as well. If the next month the market goes down, let's say 4%, they'll put a -4 in your column as well. Now at the end of the year, they'll sum up all of these monthly changes up to 2% on the upside, but it's not capped on the downside. Whatever the number is at the end of the adding up of those 12 instances, that's how much interest they credit you. But if that number should become a negative number, you don't lose anything, they don't take anything away from you. Probably the worst year for the monthly sum, I believe it was year 2013-ish, which was the Greek debt crisis, where we had clients who, through the monthly sum, they were on pace to make about 16% that year. So they were loving it, and they were expecting to get a very high amount of interest credited. But in the last month, the Greek debt crisis, the market dropped 16%, and it offset an entire year's worth of gains. So the monthly sum is kind of like, in baseball terms, a home run hitter. It either hits a home run or it strikes out. There's not much in the middle. But if you're a younger investor and you want to be a little bit more aggressive, but you don't want to run the risk of a loss, the monthly sum could be a good option for you. What your financial advisor will do for you is they'll talk with you each year about which indexes do you think are best for the next year going forward, and which crediting methods do you think are the best for the next year going forward. Would it be the annual point-to-point, which is simple? Would it be the averaging, which is consistent? Or would it be the monthly sum, which is a love it or hate it? And that's a great discussion to have with your financial advisor, and one that you should be having with them each and every year as you're owning your indexed annuity. In addition to the 3 basic crediting methods that everybody tends to have with annual point-to-point, monthly averaging, and monthly sum, there's also some niche indexes that are coming out. We've heard of trigger indexes, where if the market goes up by any amount, you get a fixed amount of interest, but if the market goes down, your account stays level. We've also seen some reverse indexes, where when the market goes down, you're credited interest, but when the market goes up, your account stays level. We've also seen some blended indexes, where it's an index made up of other indexes. And we've also seen some dynamic indexes, where maybe the index is made up of stock market with cash or stock market with bonds, and they'll move back and forth throughout the year between the two to try to lock in some gains in a volatile year. If this discussion is not happening with your current advisor, we're happy to have this discussion with you. You can send us an email or give us a phone call. The message machine's always on. We're here to help. Just let us know. With an indexed annuity, you can also add riders. These are things that get added on to the basic investment to enhance it or change it in some way. When it comes to riders, though, they always sound good, but you want to double check what the possible costs and trade-offs are to make sure that they're still right for you. Oftentimes, when you dig a little deeper, you might end up feeling like I do, which is most riders aren't really worth the cost that they add to the investment. The most common rider to add to any type of an annuity, be it indexed or any of the other types, would be an income rider. Now, an income rider guarantees a certain level of income that you cannot outlive, and you still own and control the principal. But an income rider does not guarantee a rate of return, and an income rider does not guarantee that your principal remain level either. Too often, income riders come with heavy fees attached as well. So if you're looking at an income rider, see what the benefit really is. Typically, you're just receiving your own money back for the first 20 years. It's only after the 20-year mark, if the account didn't earn a lot of interest, that the rider's actually paying you anything out of the insurance company's pocket rather than your own. So that's why I'm apt to say, if the rider has a fee, especially if it's an income rider, don't take it, because it's not really worth it for the first 20 years. Another popular rider to be added to an indexed annuity would be an enhancement on the income rider in the event of long-term care. Now, if I seemed a little bit negative on the income rider, I'm a lot negative on the long-term care rider. And that's because annuities already have a built-in protection when it comes to long-term care. And it has to deal with annuitizing or turning the account into a pension. Married folks can turn their annuities into a pension that is not considered an asset that Medicaid would make you spend down. Now that's a little bit beyond the scope of today's video, but you can follow the link below to see an excellent video on how to put barriers between your health and your wealth. So when it comes to these long-term care riders, they're not worth paying anything for at all in any circumstance, in my opinion. And that's because why pay for something that you can get for free that's already built in? The final type of rider that can be added to an indexed annuity would be a death benefit rider. This will enhance the death benefit in some way to your beneficiaries. There are a few death benefit riders that I like, but you might notice a theme here. They're all free. I only like the free riders. I don't want clients to be spending money on fees for a safe investment. A typical death benefit rider that is free might be if your kids withdraw the money over time rather than all at once as a lump sum, they'll get more. And usually it's substantially more, like 20–25% more. So that can be a death benefit rider that can be added to an indexed annuity with no fee as well. In summary, an indexed annuity is a safe investment that gives you the opportunity to earn interest based upon the stock market. You pick the stock market indexes you most want and the crediting methods that you think will be best for you. You also have the opportunity to add riders, but I would suggest you be very frugal and keep the purse strings pulled tight when it comes to riders. Just a basic indexed annuity is a great investment for growing money in a safe, protected manner. So if any of this is of interest to you and you'd like to learn more, you can follow the links to related videos below or reach out to us. We're happy to hear from you. We'd love to talk.